Hey everyone, Bill Lethman here for MoneyEvolution.com. In today's video blog, I want to talk about what rising interest rates may potentially do for your portfolio and for your retirement. So why am I talking about this? Well, as you may know, interest rates are starting to creep up here a little bit. I think we hit the bottom of the interest rate cycle here last summer in July 2016, where if we're looking at the 10-year treasury, the interest rates got down to an all-time low, the lowest they've ever been to, of 1.37%. As of about a week ago or so, we're just a little bit over 2.5%. So we're starting to see a little bit of interest rates rise. What you may or may not necessarily realize is what happens to your bonds that are part of your portfolio, or that may be part of your portfolio when we see these rising interest rates. Well, the way I like to think about it is if you think about it kind of like a mechanical lever here, and on one side you have interest rates, and on the other side you have the principal value of the bonds that are part of your portfolio. And basically there's an inverse relationship between interest rates and your principal value. So if interest rates go up, your principal value is going to go down. And if interest rates go down, the principal value of your bonds goes up. Of course, if you buy a bond and you hold it to maturity, you're going to get back exactly the amount that was promised to you by the issuer of the bond, assuming they make good on their promises here. But in the meantime, your bond prices are going to fluctuate on your account statements depending on where these interest rates are going. So I'll give you a quick example of this. Let's say today you buy a $1,000 bond that's yielding 4%. And let's say tomorrow interest rates go all the way up to 5%. Well, first of all, if that happened, you'd be pretty bummed out because you just bought a 4% bond when the new bonds are being issued at 5%. But what if you wanted to sell that bond? Could you? Well, you could always sell something, but you may not always necessarily get back out of it what you want or what you think you're going to get out of it. So in order for you to sell that bond that is in a 5% interest rate environment, you're going to have to actually lower the price or discount the price of that bond to make it equivalent to all the new 5% bonds that are being issued out there. And then, of course, the opposite is true as well. If you bought a 5% bond today and interest rates go down to 4% tomorrow, you'll be able to charge a premium for that bond. In other words, charge more than what that bond is ultimately going to mature for because you want to make that equivalent to all the new interest rates. So that's basically how interest rates work. And so as you think about your portfolio, think about how these potentially rising interest rates might affect some of your assets that you have inside your account. Now, the other thing here too is it also depends very much on the maturity length of the bonds that are in your portfolio. And if you think of this like a mechanical lever, your shorter term bonds, let's say the ones that are going to mature in less than 5 years, are going to fluctuate much less for every percentage change in interest rates. But when we go all the way out here to the 30-year bonds, we're going to see much bigger fluctuations in that. So one of the ways that we can tell how volatile a bond portfolio is going to be based on moves in interest rates is something called duration. And what duration means is it's an effective way to kind of tie in the maturity date of the bond that you're looking at along with any coupons that might be paid along the way and kind of create an effective maturity date or duration. And so if we had a duration of 5, for example, what that would mean essentially is that if interest rates were to go up by 1%, we would see a 5% decline potentially in the principal value of that bond. On the other hand, if we saw a 1% decline in interest rates, we would see a 5% move up in the principal value of your bond. So duration is something very important to look at, especially if you're looking at the portfolio. You might even want to know what is the total duration of your entire account. So pay attention to that as well. The last thing I want to talk about here is an article that I read here recently that actually was part of what prompted me to put this video together. And it was a research report from Wells Fargo. And basically what this talked about was the Barclays U.S. Aggregate Bond Index. And essentially what they talked about in this article was that the Barclays Aggregate Bond Index has actually increased the duration of that portfolio by 62% over the last 8 years. So from July of 2008 to December 31st of 2016, the average duration has gone up by 62%. Effectively, what that's doing is that's raising that duration and also raising the risk if interest rates were to go up. and that Barclays Aggregate Bond Index might be something that could even be tied to some of the assets that you have in your portfolio. So anyway, I hope this video has been helpful. Understanding the relationship of how interest rates work with the principal value of your bonds, I think, is very important. And again, if you have any other questions, please feel free to reach out to us. Let me know how you liked the video. And again, if you're watching this video any place other than our blog at moneyevolution.com, head over there, check it out. We got lots of other free resources and articles that can help you on your path to retirement. Thanks. I'll see you in my next video.